Have you ever wondered how trading options can be the best business in the world? Welcome, dear listener, to the intriguing world of options trading, a realm where financial savvy meets strategic thinking and where the potential for profit can be as vast as your ambition. Imagine a business with high profit margins, a business that allows you to harness the power of the financial markets from the comfort of your home office or even on the go. This is the allure of options trading. It's not just a financial tool, it's a business opportunity that offers the potential for significant returns. Options trading is like a game of chess. It requires strategic planning, a keen understanding of the market, and a healthy dose of patience. But unlike chess, the rewards can be more than just a triumphant smile. They can be measured in dollars and cents, sometimes in amounts large enough to transform lives. Now you might be wondering, what makes options trading so special? Well, it's all about flexibility. With options, you're not committed to buying or selling a specific stock. Instead, you're buying the option, the right to buy or sell that stock at a predetermined price. This means you can leverage market movements to your advantage without the need for a huge capital outlay. And here's the kicker. You can make money whether the market is going up, down, or sideways. Yes, you heard that right. In options trading, all market conditions can be opportunities. It's all about knowing how to play your cards right. So if you're someone who loves the thrill of a strategic challenge, if you're someone who is drawn to the prospect of high profits, and if you're someone who values flexibility in their business ventures, then options trading might just be your ticket to financial success. But of course, like any business venture, options trading comes with its own set of risks. It's not a guaranteed route to riches. It requires skill, knowledge, and a cool head. But for those who master it, the rewards can be truly astounding. Stay tuned as we delve into the intriguing world of options trading. To make the most of trading options, it is crucial to understand the key concepts of selling puts and selling calls. To put it simply, options are contracts that give the buyer the right, but not the obligation, to buy or sell an underlying asset at a specific price on or before a certain date. A put option and a call option are the two types of options contracts. Let's start with puts. A put option gives the buyer the right to sell the underlying asset at a predetermined price, known as the strike price. Now, when we talk about selling a put, it means you're the one writing the contract. You're essentially promising to buy the underlying asset at the strike price if the buyer of the put chooses to exercise their right to sell it. Sellers of put options expect the price of the underlying asset to rise or at least not fall below the strike price. On the other hand, a call option gives the buyer the right to buy the underlying asset at the strike price. So when you sell a call option, you're agreeing to sell the asset at that price if the buyer chooses to exercise their right. Sellers of call options anticipate the price of the underlying asset to fall, or at least not rise above the strike price. Now it's important to note that selling puts or calls is a risky strategy. If the price of the underlying asset moves against your expectations, you could face significant losses. But, if done wisely, selling puts and calls can be a lucrative way to generate income from your existing assets, or take advantage of market movements. A key point to remember is that option selling requires a good understanding of the market, the asset, and risk management. It's not for everyone, but for those who master it, it can be a powerful tool in their trading arsenal. Now that we've covered the basics, let's move on to the practical aspect of trading options. Selling puts can be a great strategy for making a profit in the options market. But how does it work in practice? Well, let's dive right in. When you sell a put option, you're essentially selling the right for someone else to sell a stock to you at a predetermined price known as the strike price within a specified time frame. In return for this, you receive a premium. So how do we choose the right stocks? It's all about finding a balance. You want to look for stocks that are stable and have a steady upward trend. These stocks are less likely to see a significant drop in price, which would make you liable to buy the stock at the strike price. Now, determining the strike price is a bit of an art. You want it to be low enough that it's unlikely the stock will drop to that level, but high enough that you receive a decent premium. This is where your research and judgment come into play. But what if the stock price decreases? Well, this isn't necessarily a bad thing. If the stock price decreases and hits your strike price, you'll be obligated to buy the stock. But remember, you chose this stock because you believed in its stability and upward trend. So you now own a stock you believe in, at a price lower than when you sold the put. This could be a great opportunity for future profit. However, you must always remember that there are risks involved. the stock price could fall significantly below your strike price, leading to a loss. That's why it's crucial to continually monitor the market and adjust your strategies accordingly. Selling puts can be a profitable strategy when done right. But there's another side to the options market: selling calls. In our next segment, we'll delve into that. So, stick around to learn more about maximizing your profits in the options market. Selling calls is another popular strategy in options trading, but what does it involve? Well, when you sell a call option, you're essentially selling the right for someone else to buy a specific stock at a predetermined price, known as the strike price, within a certain period. It's a strategy that many savvy traders use to generate income. The first step is to choose the right stock. This can be a bit of a balancing act. You want a stock that's stable enough to not likely plummet in value, but also not so volatile that it's going to skyrocket either. You're looking for that sweet spot where the stock is likely to stay relatively close to its current price. Once you've selected your stock, the next step is to determine the strike price. This is the price at which the buyer of the call option can purchase the stock. Generally, you'd want to set this higher than the current stock price. Why? Because if the stock price stays the same or drops, the option won't be exercised, and you'll keep the premium you received when you sold the call option. Now you might be wondering, but what if the stock price increases? Well, if the stock price rises above your strike price, the buyer will likely exercise the option. This means you'll have to sell your stock at the strike price, potentially missing out on any additional profit. However, remember that you still keep the premium from selling the call option, which can offset some of the potential lost profits. And that's the basic idea behind selling calls. It's a strategy that can generate income and potentially let you sell a stock for more than its current market price. But just like any trading strategy, it's not without its risks. If the stock price increases significantly, you might miss out on substantial profits. So it's important to carefully consider your options and make informed decisions. Selling calls, like selling puts, can be a great way to earn a profit in the options market. But remember, each strategy has its risks and rewards. As we wrap up, let's revisit some of the key points discussed today, bullet by bullet. Firstly, we delved into the world of trading options, exploring why it can be a lucrative business opportunity. It offers flexibility, the potential for high returns, and a way to mitigate risk. However, it also requires a keen understanding of the market, analytical skills, and a well-thought-out strategy. We then navigated the concepts of puts and calls. Puts are contracts that give the holder the right to sell a specific amount of an asset at a set price within a specified time frame. On the other hand, calls give the holder the right to buy. These are the basic building blocks of options trading. Next, we dove into the strategy of selling puts. By selling a put, you essentially sell someone the right to sell you a stock if it reaches a certain price before the option expires. This strategy can generate income in the form of premiums received from the buyer. However, it's important to be prepared to buy the stock at the strike price if the market price drops significantly. Then we ventured into the strategy of selling calls. This involves selling someone the right to buy a stock from you at a certain price before the option's expiry. This strategy can also generate income from premiums, but it may require you to sell the stock at the strike price if the market price rises significantly. Finally, we looked at the practical aspects of these strategies. It's crucial to remember that while selling puts and calls can provide a steady income stream, they come with their own set of risks. You must be prepared for potential losses, and it's essential to have a thorough understanding of the market and your own risk tolerance. Remember, trading options can be a fantastic business opportunity, but it's crucial to understand the risks and rewards. Happy trading!